Module 1. Money before blockchain. Before we talk about blockchain, before we talk about crypto, before we talk about any new technology at all, we need to talk about money. Because blockchain doesn't appear randomly, it doesn't fall out the sky, it exists because of how money works today. And if we don't understand money first, blockchain won't make proper sense. So let's start at the beginning. What is money? Let's begin with a simple question. What is money? Most of us use pounds, euros, dollars, what we call fiat currency. But what actually gives it value? Money is, at its core, a shared agreement. You can think of it like a shared language. If I hand you a £10 note, it works not just because of the paper, but it's because we both agree what it represents. Just like words only work because we agree what they mean. Money only works because we agree what it's worth. That agreement is built on trust. Trust in governments, central banks, financial institutions, the legal system. A £10 note has value because the government says it does. Businesses accept it, and you trust someone else will accept it tomorrow. And for the most part, that works. Modern economies depend on that trust, and most days we don't even think about it. Scarcity, rules and trust. To understand fiat money properly, it helps to zoom out. Every monetary system, past or present, relies on three things: scarcity, rules and trust. At different points in history, scarcity was enforced physically. Gold, for example, was valuable not just because it was shiny, but because it was hard to find, hard to extract and hard to create more of. Nature enforced its scarcity. Modern fiat systems work differently. They don't rely on physical scarcity, they rely on institutional rules and policy. In a fiat system, scarcity is managed, and trust is placed in the institutions that manage it. This model has enabled modern economies to function at an enormous scale as long as that trust remains intact. How modern money is created. Here's something most people are never taught in school. Most money today is not printed, it's created digitally. When governments borrow, banks lend, central banks stimulate economies. New money enters the system. This isn't a conspiracy, it's not a secret, it's how the system is designed. Commercial banks create money through lending. Central banks influence money supply through policy. It's a structured system, and again, it works as long as trust remains intact. Inflation explains simply, but there is a side effect. When more money is created, each individual unit represents a smaller share of the whole. Here's a simple analogy. Imagine you're making soup. If you add more water to the pot but don't add more ingredients, each spoonful becomes a little thinner. There's more soup, but there's less flavour per spoonful. Inflation works in a similar way. When more monetary units exist, each unit may represent slightly less purchasing power over time. Inflation isn't inherently bad. In fact, many economies it is intentional and managed. But it does mean something important. The money you hold today is designed to circulate and move, not necessarily to sit still forever. Purchasing power over time. Think about this for a moment. What did £1 buy 30 years ago? What does it buy today? What might it buy in 30 years' time? The number printed on the note hasn't changed, but what it can purchase has. The money itself looks the same, but its purchasing power shifts. This doesn't mean the system is broken. It means it was designed primarily for economic movement, wages, spending, investment, growth, not long-term storage without change. Modern money is excellent for movement. It's less focused on being permanently fixed. Trust-based systems. So modern finance is fundamentally a trust-based system. We trust that banks remain solvent, governments act responsibly, monetary policy is managed carefully, institutions apply rules consistently. And most of the time, that trust is justified. But history also shows that trust can be tested. There have been banking crises, currency debasements, capital controls, frozen accounts, hyperinflation in extreme cases. Not everywhere, not always, but often enough that people begin asking questions. It's not about panic, it's about understanding design. The question that emerged: at some point, people began asking, what if we didn't have to rely solely on institutional trust? What if rules could be enforced by systems instead of organisations? What if value could move without requiring permission from intermediaries? Not to replace the existing system, not to attack governments, not to remove banks, but to offer an alternative design. Every monetary system places trust somewhere. Gold placed trust in nature, fiat places trust in institutions. So the question became, could trust be placed in transparent rules instead? Smooth transition to blockchain. And that question is what leads us to blockchain. Blockchain is not an attack on money, it is not anti-government, it's not anti-bank. It's a response to a design challenge. How do we create systems that rely less on discretion and more on transparency, rules and verification? Now that we understand how money works today, we can properly understand why blockchain exists at all. So in the next module, we'll answer a very practical question. What actually is blockchain?